Good day, fellow investors. All roads lead to inflation. I've been browsing around a little bit and all the great minds are saying how they are not going to own any fixed income, how they are short the back end of the bond market because the only way to not go broke is actually through inflation. Einhorn is also saying how the bond market is not even beginning to price in a difficult situation in treasuries. We have already discussed the Druckenmiller interviews, his short bonds, and let's discuss the situation and see why inflation is the most likely scenario going forward and what that means for us investors. Paul Tudor Jones says that the only way out of debt is to inflate your way out, put a small tax on the consumer as that inflation goes, supporting the economy with interest rates below inflation, nominal growth rate above inflation, and over time you grow and you somehow screw the bondholders, but you get out of this huge debt issue. You have more income sources of financing to finance the interest on their debt thanks to inflation. You have to slow down your spending a little bit, but then you can close this gap. If nothing changes, given the deficits now and how those are planned to be at 7% of GDP forever and growing, this party cannot go on forever. And that's why also the investors are preparing for an inflationary environment, because when the government debt goes to 100% of GDP from 30, fueling market, financial bubbles and everything, and if we go further from the budget office projections over a few years, we go to 250, we have a 200 debt to GDP level if nothing changes, and this just keeps going on. And borrowing again to pay interest is something not sustainable, and therefore you already see that long-term treasuries, despite the Fed lowering rates, have started to creep up because they don't believe the 30-year treasury up and up. They don't believe that inflation will be at 2% as the Fed is projecting up treasuries, cost of debt up, and therefore you need inflation to solve this situation. There is no other way. If not, the financial crisis will come. At some point people will say, I will not give you money, and that's something we'll explain in a second, because when a financial crisis comes, as Tudor Jones says, financial crises percolate for years and then blow up in weeks. And this is, as he says, the proposition on debt and borrowing from the US government. The government, let's say, makes 100K per year and they are already in debt 700K. And they want to borrow 40K more every year. So the government makes $5 trillion and they want to borrow $2 trillion every year. That's 40K more on the 100 they make here. So they want to borrow more and they promise that they will pay you back in 20, 30 years. So this debt is just going to grow by 40K a year. And would you give money to the US government in this case, or to anyone in such a situation? Of course not. There is also something very important. Percentage of GDP as the US net international investment position. About 80% of US GDP, or about 20 trillion, is owned by strangers more than the US is owning around the globe. So there is again $20 trillion that might flee if things get ugly. And of course, government can increase taxes a little bit, but that's not the style of the United States. So to prevent the Minsky Moment, market collapse brought on by the current speculative activity that defines an unsustainable bullish period, exactly what we are now, and we have a long period of growth which ultimately leads to over-leveraging, which we are doing now after the financial crisis. And we are, I think, now in the Ponzi phase of that environment where we are borrowing to pay interest rate on that. And the only way to get out of that is to forget about the 2% inflation, let it go to 4-5% over time, push the economy to grow a little bit, and somehow lower debt over the years. That would be the soft landing, but that would lead to higher than estimated inflation. That has to be managed before the ugly comes into part, before inflation gets out of hand, and then we have too high inflation, too higher interest rates. That's something very important. I think that this cycle of zero interest rates that the market is pricing now, very low interest rates, it's over. The next cycle will likely be of higher rates, likely below inflation to stimulate the economy. So we have to see how to invest, and we have already seen gold and Bitcoin are already high. If we check gold going up, so investors have already been expecting this for a while. Bitcoin, the speculative Ponzi game, maybe not, time will tell. Stocks are also a good sign against inflation, but it also depends on the price and where we are going. If we look at the cheaper side of things, we have food now, we have Berkshire, some good brands in a downturn, we have retail cheap, we have some Europe and the global environment on the cheaper side of the risk and reward quadrant here. The other option is when you invest, you can be in debt, you can have a mortgage, but my pension funds owns 40 to 60% of the assets are invested in bonds. That's money we can forget about purchasing power. So that is the situation. Nobody can predict when will this happen. Will it happen tomorrow? But over the next decade or two, it's likely that the financial environment will be much different than we have enjoyed the last 40 something years.